Welcome to the April 13th, 2020 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, here again through the crisis. I'm also president McGowan Group. You can find us at NetWorthRadio.com, where the long play program is waiting for you. This weekend's broadcast focused on important strategies going forward, and we're going to give you the weekly update here on the crisis. We've been front and center for clients all through this crisis with clear strategy, clear guidance. We're going to focus on getting great assets, getting to record income, and hopefully recovering to record profits very quickly. But more importantly, as we did in 2008, 2009, we went on for superior performance for 5 years ahead of our objectives because we built record income. And those strategies are more detailed in the program. Better yet, go to NetWorthRadio.com, fill out your preliminary client questionnaire, and we'll get you a real cash flow based plan with recommendations for your portfolio that are customized for your timeline, liquidity needs, income needs, and clear objectives. Dow Jones Industrial Average, we've been looking at year to date. This is likely the most volatile 90 days in market history. The Dow was 29,500. It hit a low in the midst of the panic of 18,200. And closing the week at about 24,000, it looked like traders didn't want to be caught short over the weekend. Investors didn't want to miss the boat because part of the contention here, and I'm about to show you why, part of the debate is, did the markets overshoot the mark with this 40% decline, almost as bad as 2008, but it happened in market terms almost instantaneously. We know that a lot of the leverage came out of the system right here, and markets were clearly oversold. Do we go back and try to retest the lows? That's another part of the debate. But we have a strategy that says we can actually benefit on a longer term basis using good math that we also used through 2008, and in 2003 we also recovered to record profits in less than 12 months. I'm going to give you some details of those strategies here in this video. Interest rates. T-bill went negative. That's a minus 0.1% for 90 days. That means they're charging you to hold your cash simply because it's safe. That rate has mitigated, come back up a bit, 0.2% at the close of the week. This is the 30-year Treasury, a measly 1.4%. And the 10-year Treasury, you get a measly 0.75%. What's going to happen as the crisis begins to fade? Well, money that is left in cash is going to seek investments, I believe, with high cash flow, because your money market in May is likely to be zero. God forbid they start charging us to hold our cash. All right, now let's look at this. This is the tragedy of the number of daily new cases in the United States. And this spike to about 33,000 new cases as testing rolled out. Testing, mitigation, this phase. Now, this is the curve that you've seen, but I'm taking the updated version that appear to be driving the markets themselves. And you can see this leveling off a few days less than the day before, and a spike up here. What happens over the weekend? That's important, and next week we'll bring you the update. The thesis that you're seeing in the presidential briefings, which is important, is that this likely rolls over based upon the histories from around the world: mitigation, containment, treatment, and identification and isolation of those who have the virus. This too shall pass. It can get solved. The question is, when you get into the airliner in 6 months, are they going to have a special video that shows you how to use your mask and your air sickness bag? I look forward to that video. Just a little humor here. If we look at the high yield markets, I want to give you an update there. All right, so we hit a low of 62. Well, what does that mean? Par is 100 on a bond or a note, and when it trades in the open market, they price it above or below par value. Back in the crisis of '08, notice what happened here. This was a key part to our good math strategy that wasn't dependent on an equity rebound to record for us to get to a record. Look at that. Par value, basket of B-rated bonds and loans, kind of like what's inside a bank. And you get paid interest every month. The value of that went down to 61.5% of par value. Boom, nearly a 40% below par correction. Look how quickly that rebounded. That's part of the secret. You get paid to wait, and bonds mature at par, less the default rate. And the default rate certainly will be more because of the crisis. 1 or 2% is normal, 10% was 2008, but the Fed's actions and good managers likely mitigate that default rate inside of well-managed portfolios. Plus, there's plenty of liquidity, unlike 2008, when the value of your house and nearly all commercial real estate was down by 30 to 50%, depending on the point in the crisis. That's important because real estate trades on cap rates. So do financial assets. Now, that's the rate on your capital. What do you get paid? Well, look at this. We went through a 2016 temporary credit market crisis at 75. Great opportunity, by the way, in baskets of well-managed bonds that pay good interest. We were getting some yields as much as 10% here, and here's the recovery from that. Here's the 2018 correction. We forget we had a bear market in 2018 as well. If you're worried about a bear market, we've had 2 in 2 years. That's pretty harsh. And so here we look at what happened on the high yield. Whoa, it looks like this. It goes down below 70 cents on the dollar. And this is a short-term basket. There are baskets of bonds that actually are trading less, well managed with higher yields. I'm going to take 2 examples of what helped us recover in 2008, but more importantly, build to record income and record profits in '09. No guarantees it happens the exact same way, but the math is correct. And we can use this to get to record income or near it. Here's how. These are 2 examples, not recommendations for your portfolios. We choose these based upon the best discounts at the time we implement a model allocation. We do it for me, we do it for everybody. And what happens here, what we see is the 6 years that include, and by the way, the crisis of 2008. They thought everybody was going broke. Houston A-rated airport bonds went from 100,000 par to 68,000 at one time. Perfectly good bond, matured at 100, paid $5 grand a year. That's a great example of what's happening right now and what happened in '08. Well, 2 well-managed funds, one global high yield, one domestic high yield. And we saw this huge correction, right? But they were still paying. As a matter of fact, neither of these cut their dividends because they had a good, well-managed basket of bonds. They actually found some better bargains too, and one of them paid a bonus at the end. So if you reinvested your dividends, you're getting paid. And of course, here's the recovery and the compounded benefit of a graph of the total return. What did it end up being over those 6 years? Well, the top one is 14%, global high yield. Domestic high yield was about 10%. And that is through a 10% default rate simply with reinvestment. That was a more reliable solution, in my opinion, than waiting for equity, which took about 3 years to recover. You can see these recovered during 2009 and it went on from there. And that was part of how we handled that crisis, as well as the tech wreck 9/11 crisis of 2001, 2002. So there's your update with clear guidance on what I believe is best. Remember, you have 2 buckets. You've got the conservative bucket, and if you want it not to fluctuate, should be a money market or cash. For the long-term investment bucket, measure it right now by what it pays going forward. because cap rates are what we talk about in the longer program at NetWorthRadio.com. I'm Spencer McGowan. Pleasure to be with you through the crisis. Be sure to call anytime. We are looking forward to navigating this crisis and making sure that we do the right things for long-term benefit. Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President, McGowanGroup, your financial weatherman. We sponsor each week NetWorthRadio.com broadcast that has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast-breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as NetWorthRadio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to NetWorthRadio.com, the McGowanGroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of 02, 08, 2018, and the recoveries through the most recent quarter. That is true education of investors and exactly how our clients have done, disclosed right here. Further disclosures, value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast. And that can actually work to your advantage. We'll build that into your plan. So I urge you to go to NetWorthRadio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast or any securities doesn't make it a recommendation for your portfolio until you have that written plan. Thank you for tuning in today, and we'll be back next week as your financial weatherman.